This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Here's what most beginners do when they open a chart for the first time. They zoom into one candle, maybe two. They look for a pattern they memorized and they trade it. No context, no bigger picture, just shapes in a vacuum. And then they wonder why it doesn't work. Here's the uncomfortable truth. You can know every single candlestick pattern in existence, every reversal signal, every continuation setup, and still lose money consistently. Because patterns don't exist in isolation. They happen inside something bigger, something that most traders completely ignore. It's called market structure, and understanding it is the difference between trading with a compass and trading blindfolded. Market structure tells you the one thing that matters more than any pattern. Which direction is the wind blowing? Is the market trending up, trending down, or going absolutely nowhere? Because the answer to that question changes everything about how you read a pattern. A bullish reversal at the bottom of a downtrend? That could be gold. The same pattern in the middle of a strong uptrend? It means almost nothing. You already know the trend is up. That same pattern inside a choppy range? It's a coin flip. If you don't understand the structure first, you're just guessing. And guessing is not a strategy. Today, I'm going to show you how to read any chart in about 30 seconds. Trends, ranges, and the messy stuff in between. By the end of this lesson, you'll never look at a chart the same way again. So what exactly is market structure? Think of it as the skeleton of the chart. It's the framework that everything else hangs on. Patterns, signals, entries, exits, all of it only makes sense when you understand the structure underneath. Market structure answers one simple question. What is price doing right now? And the answer is always one of three things. Number one, price is trending. It's moving in a clear direction, either up or down, making progress and showing momentum. Number two, price is ranging. It's stuck between two levels, bouncing back and forth like a ball between two walls. No real direction, no real progress. Number three, price is choppy. It's all over the place. No trend, no clean range, just noise. Random moves with no follow-through. Every chart you ever look at any point in time, is doing one of these three things. And each one requires a completely different approach. If you try to trade a trending strategy in a range, you'll get chopped up. If you try to trade a range strategy in a trend, you'll get run over. And if you try to trade anything in chop, well, good luck. The first step to reading any chart is identifying which of these three states you're looking at. And once you know that, everything else becomes clearer. So let's break each one down. Let's start with uptrends because they're the easiest to understand and the most fun to trade. An uptrend is defined by two things: higher highs and higher lows. That's it. That's the whole definition. Price makes a high, pulls back, makes a higher low, and then pushes up to make a new higher high. Then it pulls back again, makes another higher low, and pushes higher again. It's like climbing a staircase. Each step takes you higher than the last one. You step up, you rest on the landing, then you step up again. As long as each high is higher than the previous high and each low is higher than the previous low, the uptrend is intact. Now here's something critical that beginners miss. An uptrend doesn't mean price goes straight up. It doesn't move in a straight line. It moves in waves. Up, pullback, up, pullback. Those pullbacks scare a lot of new traders. They see price drop for a day or two and they panic. They think the trend is over. But as long as price makes a higher low, the trend is alive. Think of it this way. Each higher low is the market telling you, buyers are still in control. They're stepping in earlier than last time. They're not waiting for price to come all the way back down. They're eager, they're aggressive, and that's bullish. The key rule for uptrends: look for buying opportunities at higher lows, not at higher highs. Buying at a new high means you're chasing. Buying at a higher low means you're getting in where the smart money is stepping in. On your chart, you can draw a trend line connecting those higher lows. That line becomes your guide. As long as price stays above it, the uptrend is your friend. A downtrend is the mirror image. Instead of higher highs and higher lows, you get lower highs and lower lows. Price makes a low, bounces up, but only makes a lower high, then drops to make an even lower low. Then it bounces again, makes another lower high, and drops to another lower low. Each bounce is weaker than the last. Each drop takes price to a new floor. It's like walking down a staircase now. Each step takes you lower. You drop, you rest briefly, then you drop again. As long as each high is lower than the previous high, and each low is lower than the previous low, the downtrend is in control. And just like with uptrends, downtrends don't move in a straight line either. They have bounces, they have relief rallies, and those bounces fool a lot of beginners into thinking the bottom is in. They see a green candle after 3 red candles and they buy, thinking they caught the reversal. But in a downtrend, those bounces are usually just sellers catching their breath before the next leg down. Here's the key mindset shift for downtrends. Each lower high is the market telling you, sellers are still in control. Every time buyers try to push price back up, sellers step in earlier than last time. They're more aggressive. They're not letting price recover, and that's bearish. The rule for downtrends: look for selling opportunities at lower highs, not at lower lows. Selling at a new low means you're chasing the move down. Selling at a lower high means you're getting in where sellers are showing their strength. Connect those lower highs with a trend line, and you have your guide. As long as price stays below it, the downtrend is in charge. Now, ranges. This is where most beginners get absolutely destroyed, because ranges look deceptively simple, but are actually the trickiest environment to trade. A range is when price gets stuck between 2 levels: a ceiling, which we call resistance, and a floor, which we call support. Price bounces up to resistance, gets rejected, drops back down to support, bounces, goes back up to resistance, gets rejected again, back and forth, back and forth. It looks like easy money, right? Just buy at support, sell at resistance, repeat. And in theory, yes, that's exactly how you trade a range. But here's the problem. Ranges are messy. Price doesn't always bounce cleanly off support and resistance. Sometimes it pokes above resistance for a session or two, traps everyone who bought the breakout, and then reverses back into the range. Those are called false breakouts, and they're extremely common in ranges. They're designed to fool you. The same thing happens at support. Price dips below, stop losses get triggered, traders panic sell, and then price shoots right back into the range. The market just shook out the weak hands and continued doing nothing. So how do you survive a range? First, identify it clearly. If price has bounced between the same 2 levels at least 2 or 3 times, you're probably in a range. Second, trade from the edges, not the middle. The middle of a range is no man's land. You have no edge there. Only take trades at support or resistance, with a stop just beyond the level. And third, and this is the most important, be ready for the breakout. Every range eventually ends. Price eventually breaks out of the box, either up or down. And when it does, the move can be explosive. The longer the range lasted, the bigger the breakout tends to be. Quick pause. If you're working on building something bigger, whether it's your trading career, a side hustle, or a new job, make sure your resume is as sharp as your chart reading. Check out Resume Zenith. Clean, professional resumes built fast. Link is in the description. Alright, hit that like button, subscribe if you haven't already, and tap the bell so you never miss a lesson. Let's keep going. Now the third state, choppy markets. And honestly, this might be the most important section of this entire lesson, because the best trade you'll ever make might be the one you don't take. Choppy price action is when the chart looks like a mess. Price is moving up and down with no clear direction, no clean structure, no obvious trend, and no well-defined range. It's random. It's noisy. It's the market saying, I don't know where I'm going, and neither should you. Beginner traders try to trade chop because they feel like they need to always be in a trade. They feel like sitting on the sidelines means missing out. But the reality is the opposite. Trading in chop is the fastest way to blow an account. You get faked out, whipsawed, stopped out left and right, and by the end of the week, your account has been death by 1,000 cuts. Here's how to identify chop. The candles are small and overlapping. There are lots of wicks and small bodies. The moving averages, if you use them, are flat and tangled together. There's no separation, no direction. If you look at the chart and you can't immediately tell whether it's going up or down, it's probably choppy. The rule is simple. When the chart is choppy, close the laptop. Go for a walk. The market will still be there when a clean trend or range develops. Protecting your capital when conditions are bad is not a sign of weakness. It's a sign of discipline. And discipline is what separates profitable traders from everyone else. Now here's where it gets really powerful. Markets don't just flip from uptrend to downtrend like a light switch. They transition. And understanding how those transitions work gives you an enormous edge. Here's the typical sequence. Price is in a nice uptrend. Higher highs, higher lows, everything's clean. Then one day, price makes a new high, but the pullback goes deeper than usual. Instead of a higher low, it makes an equal low. Or worse, a lower low. That first break in the pattern is your early warning. The uptrend isn't necessarily dead yet. but it's showing the first sign of weakness, like a crack in a wall. The building might still stand, but you should probably pay attention. What often happens next is that price enters a range. It stops making higher highs and starts bouncing between two levels. This is the transition zone, the tug of war between buyers and sellers, and eventually, one side wins. If sellers win, price breaks below the range support and starts making lower highs and lower lows. The downtrend begins. The reverse works the same way. A downtrend shows a crack when price fails to make a new lower low, or makes a higher low for the first time. Then it enters a range. Then if buyers win, it breaks out to the upside and a new uptrend begins. Uptrend, range, downtrend, range, uptrend. This is the cycle, and once you see it, you'll see it on every chart, every time frame, every market. It's the heartbeat of price action. The practical takeaway: when you see the first break in structure, that first failed higher low or failed lower high, start getting cautious. Don't fight the transition. Let the new structure reveal itself before you commit your money. So here's your 30-second chart reading process. This is what I do every single time I open a chart, and it takes me about 30 seconds before I even think about looking for a pattern. Step 1. Zoom out. Look at the last 50 to 100 candles. Don't zoom into the last 5 candles. You need the big picture first. Step 2. Ask yourself, is price making higher highs and higher lows? If yes, it's an uptrend. Look for buying opportunities at pullbacks. Step 3. Is price making lower highs and lower lows? If yes, it's a downtrend. Look for selling opportunities at bounces. Step 4. Is price bouncing between two clear levels? If yes, it's a range. Trade the edges and be ready for the breakout. Step 5. If none of the above apply, if the chart just looks messy and you can't tell what's going on, it's probably choppy. Stay out. Find another chart. That's it. 5 steps, 30 seconds. And now you have context. Now you know the environment. And only now should you start looking for candlestick patterns. Because a bullish pattern in an uptrend pullback is a high probability trade. The same pattern in a downtrend bounce is a low probability trade. Same shape, different structure, different outcome. This is what separates the 90% who lose from the 10% who win. Context. Here's your homework, and I really want you to do this one because it's going to change how you see charts. Pull up TradingView. It's free. Open any 5 charts. Stocks, crypto, forex, doesn't matter. For each chart, I want you to do the 30-second read. Zoom out, look at the last 100 candles, and label the structure. Is it an uptrend, downtrend, range, choppy? Then find at least one transition point on each chart. Where did the structure change? Where did an uptrend crack and turn into a range? Where did a range break and turn into a downtrend? Just observe. Don't trade anything. Train your eyes. After 5 charts, this process will start becoming second nature. And I've put everything from this lesson into a free cheat sheet. The definitions, the 30-second reading process, the transition signals, all of it. Drop your email at candlelogictrading.com and I'll send it straight to your inbox. Print it out, keep it next to your screen, and use it every time you sit down to analyze a chart. Next lesson, we're going deep on something I've mentioned in almost every video so far: support and resistance, those invisible lines on the chart where price keeps reacting, where institutions place their orders, where the market decides, do we go higher or do we get rejected? If market structure is the skeleton, support and resistance are the joints. They're where the movement happens. And in Lesson 6, I'll show you exactly how to find them, draw them, and trade around them. New lessons drop every Sunday, Tuesday, and Thursday. Hit that like button. Subscribe if you haven't already, and tap the bell so you never miss a lesson. I'll see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.